Hey folks, my name is Chris at HouseIt, one of the co-founders here at HouseIt based in Miami, Florida. Today we're going to talk about a very interesting topic, and that is why is the Fed not going to raise rates and why you should buy more real estate. Now, as I'm sure you've heard, the Fed has talked a lot about raising rates imminently and also reducing the size of their $9 trillion balance sheet as of this writing. So that is all, those are both forms of tightening, so reducing liquidity in the markets. It obviously has knock-on effects in broader markets, and as you've seen, a lot of different asset classes have taken a hit, even before the recent events in Ukraine. So for example, growth stocks down 60 to 80%, a lot of cryptocurrencies down a lot, more other fringe assets certainly taking a hit from a reduction or a anticipation of a reduction in excess liquidity. But the title of the video we've given you is actually quite provocative. We actually think, again, this is just our 2 cents, we think that the Fed ultimately will not raise rates or will not raise rates much. Maybe they'll raise it a few times, a few quarter point hikes, and eventually they will back off. And the reason we think that is contrary to what you hear about in various sort of market commentators who actually do this for a living. They keep bringing up the example of the 1970s, where you had a brave central banker, head of the central bank, Volcker, who raised rates to anything, to as high as needed, approximately 20%, to bring inflation under control. But the difference that people miss is that unlike the 70s and today, well, keep in mind in the 70s, they had a much lower debt to GDP ratio. In the 70s, they had about 20%, I recall, debt to GDP, much lower. So Volcker was actually able to raise rates that high and still be able to have the government afford it. Versus today, we had such a tremendous amount of spending through COVID and other sort of boondoggles and such over the past several years that the debt to GDP ratio is significantly above 100% debt to GDP as of this writing in 2022. So that is a massive difference, because if you think about it, the Fed raises rates and ultimately rates across the yield curve rise. That is going to quickly become an unaffordable situation for the U.S. government. Just because there's many analyses that have been done, but say you raise rates to something more normal, 4 or 5%, it quickly takes up pretty much the entire federal government annual budget would be going towards interest expense. So it's quite a conundrum to be in. Personally, we think the situation is more analogous to post-World War II, when the U.S. government built up a lot of war debt, had debt to GDP also above 100%. And what actually happened there, and they actually instituted this in Japan quite recently, is called yield curve control or yield control. And they essentially, what that means is, the government says, here's the rate we're going to cap, say the 10-year or 30-year, whatever maturity they want, say 3% for the 30-year, hypothetically. And then they will buy an unlimited amount of 30-year treasuries to keep that yield at 3%, to keep nominal yields low. And that's essentially unlimited QE in terms of keeping the rates low, interest rates affordable for the government. And then what actually happened in that era with inflation? Well, they let inflation run hot. So they kept yields low, yield curve control, and inflation was in the, say, high teens, 20s, 30% range. So very high for a country like the U.S. And, that, of course, does work in the sense that it burns essentially the debt through, when you have high inflation, obviously, it's good to be a debtor to owe money, because the real value of that debt you owe decreases dramatically with high inflation. So, it does work and I guess solve the problem, but of course, it's a huge equivalent of a tax. It's very painful for people who hold that debt and who hold that currency in the form of cash. So again, this is why we've had a few videos recently on real estate and why it's such a popular inflation hedge asset, why there has been so much capital and investment flowing into real estate, and in particular to markets that are really growing as well, such as Miami real estate. And this is why, historically people have bought real estate when inflation was high, why in the 70s Americans protected themselves by buying, things that they don't make any more of, such as waterfront property. So anyway, we hope you found this video helpful. If you did, please hit like or subscribe. If you have any other questions, leave us a comment below. We'd love to help answer them any way we can. Again, this is, we always talk about real estate here, but we do try to add some commentary on the broader markets and such, because our readers find it interesting, and also because the broader markets do affect the real estate market. So we want to make sure our customers and viewers are informed as much as possible. We'd love to know what you think. Shoot us an email, team@houseit.com, or better yet, again, leave a comment below, hit like, subscribe. My name is Chris at Houseit, and if we can ever help you buy or sell property in New York or Florida, let us know, and we can help you save all 6% in broker commission with an agent-assisted FSBO listing. If you want something more hands-on, we have a 1% for full service listing option, where an agent from our side takes care of everything for you. And of course, when you buy, we can give you 2/3 of the buyer commission that we earn, subject to us keeping a small minimum. It can be quite substantial, because instead of the traditional sort of 3% to buyer's agents, here in Miami, some new construction buildings offer 5, 6, 7% in commission to buyer's agents, which means 2/3 of that to you can be a lot more than you expect, and can help cover your closing costs and more. My name is Chris at Houseit, and we'll see you on the next one.